Joining us now for more is Stephen Schork. He's editor of the Schork Report. And Stephen, when you take a look at the reaction that we're seeing in crude, jumping about 3%, but I think it's relatively muted compared to what it could have been. What do you think?
Yes, absolutely. And that's been the ongoing story now for the past year. We have to keep in mind that Iran has spent the better part of 2019 chumming the waters. That is to say, trying to bait the United States into a deepening conflict, whether it was the seizure of oil tankers, the mining of the Strait of Hormuz, the downing of U.S. drones, the drone attack orchestrated by Iran on the Saudi Aramco facility in September. You've always had these provocations, but you didn't have a response up until this point. So to that degree, the calculus has changed. So I think the market is going to its old playbook where we've had these provocations. And as Osama bin Laden taught us back in 2001, unchecked provocations only lead to further and greater provocations. So there was not a response in any of the provocations from last year. So we are certainly starting the new year on a fresh sheet of paper here, and we do have the response. I am a little concerned that the market is kind of relying on what happened back in 2019 when we did not get the response. But clearly, this response by the United States to the embassy siege staged by Iran a few days ago, the ball is back in the Iranians' court, and we're going to wait to return serve. So yes, we did have a material rise in prices today. To your point, not nearly as great as you would suspect. So I think the market is certainly going to take a wait-and-see attitude. That said, the market is clearly not positioned for this event. When we look at the option flow or the money flow in the option markets, the market is betting on a ceiling in oil prices, non-mixed WTI, upwards of $65 to $66 a barrel. We're still a few dollars below that, but if we see any further hardcore response and then an escalation in this conflict, we could easily break that $65, $66 ceiling. And then without any overhead protection at that point, then the green light is there for bulls for a significant spike in price.
Stephen, from how you see it, you mentioned the potential of the fact that they could maybe seize ships or some tankers. They've done that in the past. There's also talk that they could possibly try and close the Strait of Hormuz. If either of those events happen, I know you were saying that we see upside risk. Crude could break above that $65 to $66 a barrel level, but how high could it go?
Well, it could go considerably higher. Right now, our quantitative models, which take into account the volatility and elasticity of past events, do show by the end of the first half of this year that oil prices, non-mixed WTI, could be well above $75 a barrel, pushing that $80 a barrel range. But we want to keep in mind, though, that for all intents and purposes, the industrial side of the U.S. economy, the factory economy, is in recession here in the United States. It's certainly in recession in Europe, and of course, it's in recession in China. All this being fallout from the ongoing trade rift between Beijing and Washington. So any material spike in oil prices will further exacerbate demand decay for oil, which ultimately, long-term out, will have a deleterious impact on price. That's something that the Iranians nor people in Texas really want to see at this point. So to that end, that what I'm really concerned about, and this is interesting, kind of listening to the commentariat on the television all day, people that normally don't follow the oil markets are really taking a kind of nonchalant stance on this, saying, oh, the United States, we produce 13 million barrels a day. We don't care. We're not worried about these oil prices. You know what? The United States still imports 3 to 4 million barrels of crude oil a day. So it is a significant to that point. So when you juxtapose this nonchalance on some of Wall Street's non-oil people, the fact that option riders are not prepared for this event, if you do get to that point of closing of the Strait of Hormuz or the seizure of tankers, we could be upwards of our model's upper elasticity range in that $70, $75 range.
All right, Stephen Schork, thanks so much for breaking all this down for us.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.